Hello, and thanks for joining us for our quarterly investment perspective review. I'm Aldo Voltaggio, Chief Investment Officer at Capstone Financial Advisors. The following is general commentary on the markets and economy and his opinion. First, a quick market review. In the first quarter, global stocks continued their upward trend from last year, buoyed by resilient profit growth and enthusiasm around artificial intelligence. Despite uncertainties like interest rate policy and geopolitical tensions, stock prices rose and market volatility stayed low. However, global bond markets pulled back a bit after a strong fourth quarter, with longer-term rates rising, especially in the U.S., negatively impacting bond performance. The increase in longer-term rates reflected a shift in expectations for fewer Federal Reserve policy rate cuts due to ongoing economic strength and persistent inflation. Looking ahead, stock market gains may continue due to strong economic activity and supportive monetary and fiscal policies. Despite high stock valuations, continued positive earnings surprises and broader sector performance could fuel further gains. However, negative catalysts like a significant economic slowdown or geopolitical war escalation could lead to market declines. Bond returns should stay positive this year due to their current yields and the near-term outlook for interest rate policy. Investment-grade bonds now yield between 4.8% and 5.9%, and despite higher inflation data recently, central banks are unlikely to hike rates soon. In the U.S., the Fed's next move may be a rate cut or maintain rates where they are. In both scenarios, however, bond investors stand to benefit. Lower rates would boost bond prices, increasing returns, while steady policy rates would help bonds maintain their attractive yields. On the economic front, the U.S. economy started the year well despite the Fed efforts to curb inflation by keeping policy interest rates high. First quarter growth in the U.S. was estimated to be at 1.6%, slightly below expectations, but still positive, driven by a strong job market and consumer spending. Workforce and productivity gains boosted job growth and wage increases supporting household consumption. Inflation was higher than expected throughout the first quarter due to increased service prices. This trend dashed hopes for a Fed rate cut occurring this summer. Abroad, major European economies have broadly stagnated due to prior year's interest rate hikes, and global trade weakness has particularly impacted export-oriented European country manufacturing sectors. However, the good news is that Europe has avoided a deep recession. Inflation is nearing the central bank targets, and the job market remains stable. In China, broad economic challenges persist. However, the government's efforts to boost manufacturing and export sectors appears to be working as indicated by improving industrial data. Meanwhile, Japan ended its 8-year-long negative interest rate policy, signaling the end of deflation. Recent stronger than expected wage increases indicate that the Japanese economy has finally started to see internally driven economic and inflation growth. Looking ahead, the U.S. economy is likely to stay strong with ongoing job growth the rest of the year. The country's unemployment rate is likely to remain stable, supporting continued consumer spending. However, spending may slow due to diminished wage increases and tight lending standards. Inflation should resume its gradual decline, but achieving the Fed's 2% goal may likely take longer than anticipated. With elevated inflation and a strong economy, rate cuts are not likely in the near term. Europe's economic outlook will remain challenged in the short term. However, the intermediate term outlook may be brighter than expected. Economic data that gauge future activity are either in expansion territory or inflecting upwards in most major European economies. And with inflation nearing 2%, rate cuts by the European Central Bank could come as early as June. And while China's recovery may be uneven due to the housing downturn, further government policy is likely to continue supporting the manufacturing sectors and boost consumer spending. Meanwhile, Japan's economy may continue exiting a deflation environment, likely leading to increased consumer spending and business investment. The surge in interest rates over the 18-month period starting in early 2022 led to downward pricing of stocks, bonds, and real estate markets. Commercial real estate, already challenged by the pandemic, now faces additional hurdles with impending debt refinancing. I'll talk about the current state of the real estate asset class and what may lie ahead for it. But first, why should one invest in commercial real estate? Commercial real estate is the third largest investable asset class in the U.S., offering diversification from stocks and bonds. While stocks may offer higher growth potential, real estate investments generally provide higher income and tax efficiency. Additionally, real estate acts as an effective inflation hedge, with real estate values and rents rising with inflation over time. Amid the pandemic, office, retail, and hotel sectors were significantly impacted. However, since then, retail and hotel sectors have shown remarkable recovery. Despite some retail closures, shopping in person remains predominant, especially in higher-end retail spaces with experiential entertainment centers and grocery stores. And the hotel sector has bounced back with complete recovery in air travel. On the other hand, the office sector continues to struggle due to the hybrid work model. Older, non-Class A office buildings in less desirable locations are particularly affected. However, the office sector now represents a small portion of the overall commercial real estate market. Because of this, further declines in the office sector are expected to have much less impact on the performance of the overall real estate asset class. Moreover, the remaining office properties are increasingly newer and updated Class A buildings. Conversely, industrial and apartment sectors have continued to thrive post-pandemic, driven by high occupancy rates and rent growth stemming from housing shortages and the e-commerce boom. Additionally, specialty real estate sectors like cell towers, data centers, and life science medical centers are poised for continued growth, supporting the growth in technology and healthcare industries. Over $2 trillion worth of loans on commercial real estate is coming due over the next 3 years, posing significant refinancing challenges, particularly with traditional bank lenders potentially unwilling to fully replace expiring debt. This potential capital gap raises concerns that commercial real estate values broadly could experience significantly more downward pressure. However, the market has already witnessed substantial valuation declines since early 2022. Primarily driven by the surge in interest rates. Now, with the Federal Reserve pausing interest rate hikes, further downward pressure on valuations is unlikely. While traditional banks tighten lending to commercial real estate owners, non-bank lenders are increasingly filling the gap, providing alternative financing options. This transition will likely unfold over several years, allowing for a gradual adjustment period, mitigating the immediate risks of widespread defaults. Although defaults are anticipated, particularly in the office sector, their impact on the broader commercial real estate market is expected to be contained, given the staggered nature of debt maturities and the concentration of defaults in limited office segments. The past few years have certainly been challenging for the commercial real estate market, particularly the office sector. However, there are signs of improvement in the return outlook. The decision by central banks, including the Federal Reserve, to halt rate hikes and eventually cut rates should help stabilize commercial real estate values. Despite declines, many commercial real estate sectors have managed to increase rents in response to higher inflation, thereby helping future returns. And the office sector is undergoing a transformation, with a shift towards highly amenitized Class A buildings in desirable locations, while older properties are being repurposed or rebuilt. Additionally, public commercial real estate markets, including real estate investment trusts, are currently trading at significant discounts to underlying property net asset values. Historically, such discounts have been followed by higher than average returns in the immediate subsequent years. Similarly, the private commercial real estate market has historically shown attractive returns following significant drawdowns. Therefore, maintaining a long-term strategic allocation to real estate is recommended despite current and near-term challenges. Real estate investments offer benefits such as capital growth, income, tax efficiency, diversification, and protection against inflation. Looking ahead, most commercial real estate sectors are expected to benefit from lower starting valuations, sustained macroeconomic tailwinds, and favorable prospects for continued rental income growth. Our portfolio recommendations are shaped by current market conditions and long-term investment perspectives. First, strategically use stock market rallies to your benefit. We advise investors to stay disciplined by selling overpriced assets during rallies and reallocating to underperforming asset classes. This strategic approach may sound counterintuitive, but can enhance long-term portfolio returns and lower portfolio risk over time. Second, take advantage of the current opportunities in real estate and infrastructure securities. Publicly traded real estate and infrastructure securities have lagged behind broader stock markets due to rising interest rates. Their prices are particularly sensitive to interest rate increases, which have led to declines and significant valuation discounts over the past 2 years. This presents attractive opportunities for investment in these asset classes. Lastly, seize the better yields now available in high-quality intermediate-term bonds. Longer-term interest rates, especially in the U.S., have risen this year, resulting in bond market price declines. However, this presents another opportunity for investors to secure higher yields with investment-grade intermediate-term bonds. Allocating to high-quality, longer maturity bonds can help better offset stock risk in a portfolio. And in a tougher economy, the eventual central bank rate cuts will likely lead to bond price gains. Thanks for watching. For more information on this topic, click the link in the description below. And don't forget to watch the next installment of this series. It's on your screen now.